All right. Good morning, everybody. So the volume this week is going to be really light, really light. Volume today will be likely the lightest. Europe is closed for holiday, so we don't have their volumes, as well as just, a lot of people just aren't here. Hong Kong getting that shadow stimulus up 1%. Small caps, 3/4 of a third of a percent, third of 1%. Everybody else is basically flat. So we're going to get a little bit of home data this morning, and then later at lunch, we'll get some auctions. I was reading seasonality on gold. Apparently, January is the greatest month, seasonally speaking, for gold. And of course, we are right up near technical all-time highs on that thing. And with the moves in the dollar, we could see an all-time high breakout in dollar. Bitcoin is down this morning, so that's going to mess with liquidity as well. I was reading about priced in rate cuts around the world. The Federal Reserve has 156 basis points priced in for, just say the US. Europe, 161. Bank of England, 141. Swiss National Bank, 86. Bank of Canada, 120. Australia, 53. New Zealand, 93. Those are some amazingly bullish sentiment globally, all around the world. We're looking at that. And if you had time over the holiday to maybe do a light read on forecasts, say from Goldman Sachs, JP Morgan, a lot of the forecasts continue to focus on US next year as the dominant market, because China's still failing to kind of recover the way it was expected to after COVID. Remember, they were in a lockdown, that total zero COVID that they were trying to achieve, and they were locking everybody down way after everybody else had already come out of lockdown. So the idea was that China was going to be a late bloomer, but that when they ended that zero COVID, that there would just be like this economic boom over there. And we haven't seen that. We continue to not see that. So while their projections are still low, the projections right now are that the US is going to dominate next year. We've seen a little bit of that in late 2019, 2020. Right? And we had that dollar, a strong dollar, the Dixie continuing to go to the upside, and we had the NASDAQ matching it point for point. They were both just continuing to run together higher. Completely opposite of what we've had going on around here, right? Where we've had over the last 16, 18 months, the dollar up, indexes down. $8:30, 9, 10:30, 11, 11:30, and 1 o'clock. And a lot of those at 11, 11:30, and 1, those are all auctions. We got the 52-week today, and the rest are all really front end. The 2-year, the 6-month, 3-month, and 1 week, or 1 month, 4 week. these are not trivial, right? So you really want to keep your eye on how the auctions go. And yeah, it's the holiday, so it's not like we're expecting a lot of participants, but whether there's anybody participating or not, there's obligated banks that'll cover it one way or the other. Get your paw out of my water. Crackhead. My cat decides that drinking my water isn't as good as playing with it. All right, so we're above the daily pivot point. We can't call it an MDP though, because we cut through it at the open last night in Globex. So technically it's not an MDP, but consider the look of this thing. If we had just gapped a little bit higher, there wouldn't have been a touch. And you could go ahead and approach it as an MDP. There's no wrong way to do this. And even in the textbooks, they'll tell you there has to be a little bit of latitude when you're doing things like this or with the volume profile VOP. So, you just got to make your own set of rules on this if you count it as a touch or not. I think we're going to perhaps come back down and close that gap anyways, which means we would run right back through it. So I'm willing to say it's not touched yet, but once we come back down and cut through there, then it would be. That solid green line here is from a voodoo level, and it's a big one. It's why it's so bright and it's so thick. The voodoo levels, there's a lot of them that aren't quite as robust, right? It's these smaller green, they're kind of really hard to see, thin, darker shaded, but the one that we're talking about is bright green. This is one of the bigger levels, and you can see how price really interacted with it back here, right? Of course, we had that day where the flows just cut through it, but once we got above it, it really was acting as a support level or an area of interest where we saw a lot of participation. So now that we've cut through it a couple times, it's lost a little bit of its respect. It's not as valuable and as strong as it was. It's still a level to keep our eye on. I was looking at some volume flows. Got a couple of different levels here. These lower lines are from the one single day, right? The day after Christmas for 2021 and 2022. You're looking at around 850 and 975, so less than a million, right? That's the benchmark for the entire trading day, the day after Christmas. On the trading week after Christmas are these two higher lines, 4.1 million and 4.5 million between 2021 and 2022. So the volumes really are going to be a lot lighter. You can see this level. That's how low it was. So right there and right there compared to, all this other levels. A significant drop, right? So when we say the volumes are going to be a little light, it's as light as Thanksgiving, which we can see was just a little beyond, a little past, right? In breadth, we're still holding above that 10-period moving average. So in the grand scheme of things, this is a picture of improvement. We got that higher high, and it's a solid higher high. Had the bear trap double bottom deep cut through, lower than the previous low, textbook perfect trap. Crossover, we are back above all of the major moving averages. We just now need to get that 10 back through the 20. $20 doesn't look right, but maybe it's the 50 that doesn't. Something's off there. We'll figure it out in a little bit. Either way, it's above all the major moving averages. And the thing that we want to keep our eye on is that 10. Cross back down below that. We can wick down there. We just don't want to see it stay down there. But we are getting a bit of a Wyckoff, turn here, but it needs to continue to turn and start working its way back up. This one is the NASDAQ. If we look at the NYSE, well, not so much a picture of health, right? $10-day, 30-minute volume profile. As the day wears on today, we're going to lose a lot of this volume down here. And unless we can undercut that 47.50 low, then we're likely going to lose this gap that's down here, and that's going to put us in a really tight range. Right now, there's no expectation to believe that we'll break that 40.50. And by, say, late Thursday of this week, all of this will be gone. So right now, we're developing that classic P shape. Once we lose this volume down here, we will be in a classic D in a very narrow range, about 80 points. It's a 10-day range of 80 points. It's really tight. It's a lot of compression. So when we come out of this range, it's likely going to be a doozy. No VPOC to carry forward from Friday. We cut through it in the Globex last night. We still got a bracket of VPOC, one above us at 48.25, one below us at 47.80. Yeah, I'm rounding a little bit, but it's close. We're still 4% above the 10-week. Now, it is on the decline, even though price really hasn't done anything. The moving average is having time to get caught up with us, right? All we got to do is hold the line and the 10 will come to us. It's a slow transition that way, but it does get there. This is now the third week, starting into the third week where we're on a decline. It doesn't owe us all the way back to zero. We can see plenty of times throughout history where we've started the decline and then it began moving back to the upside again. Notably back here, May, June, July. We had the bank save in March and then the AI explosion. Then that kind of faded out. So even at this level, we've been higher than this before, but this is still considered a bit extended. I don't really like the term overbought and oversold, but it fits in a way. We are still extended though. That's the main thing. We could rally from here, but it would take a lot of work, right? Or, and this is kind of the reason for continuing to point it out, it would take a lot of work, or it would take a unique situation where there's a low volume environment and then a big trade comes in. Because of course, in low liquidity environments, it doesn't take very much to move the markets. And I know that's something that a lot of newer traders don't quite grasp, but that low volume makes it a dangerous market because we could really move. I mean, we could really move. We're still less than 1% away from the 10-day. We are on the run back up again. Think of this as waves, even though it's kind of choppy, down and back up through, right? So if this was the move down, then we're expecting to be on the move back up again. In the shorter duration, we're not overbought. We're not overextended. We haven't moved too far, too fast. We've got plenty of room to run. We could get a 1.5% to 2% move before we would need to start considering the fact that we might be overbought or stretched at that point. Looking at the last 5 days, we got a market that's basically flat. Finance, technology, consumer discretionary, these top three are the risk-on sectors. In a bullish market, in a healthy market, in a healthy economy, we would expect those three top line markets to flourish. Those top three also have the fangs in it, the Magnificent Seven, however you want to approach it. And they're basically flat. On the other side of that, an unhealthy economy, an economy worried about inflation, stagflation, deflation, a marketplace looking for defense will go into these lower three. The one on the left here, staples, goods and services up here, building materials. A lot of these, there's just nothing there, right? So if we start getting a flood of money coming into this market, it's very likely going to have to rotate out of whatever has been moving. So we could see utilities is down 2%, energy up, more than 0.75%, and healthcare, up more than 0.5%. But at least they have some move in there. An unwind or a fractal rotation might see those start to fade, and these others catch a bid. We did get that 5,200 cross on industrials, and it's almost destined to cross at this point in building materials. And on the top line, the 50 is still above the 200. Nothing even starting to curl to the downside yet. So all three of those top ones are a picture of health. There's not much left of the market that doesn't have this picture of health, right? We're about to cross to the downside in energy. And utilities still has a ways to go before we can get a crossover here between the 50 and the 200. But for the rest of these, maybe healthcare too has some work to do. That 50's a little farther away than I thought it was. So these two, utilities and healthcare, have a lot of work to do to get that 50 cross, and we're going to lose the 50 on energy if it doesn't flatten out here soon. Right, nat gas down 5% this morning. Bitcoin 2.25, and that's it to the downside. Just those two. And things that are up, what's that? VIX over 5.5%. Very likely because of contract change. Precious metals, China ADRs, those are worth a look. Let's go check those out because that's the last thing we got, right? Outside of precious metals, we get the China ADRs, and then that's it. Jets and semiconductors are moving around. They're just not up enough to hit our benchmark. Lee Auto this morning up almost 8%. Neo probably in sympathy, up 4%. As bottom fishing plays, this is a reasonably decent looking base, but there's a lot of work to do here. And XPEV probably also in sympathy with Lee, up 2%. Another China ADR PDD up 1%. It's a really nice flag. You know, we've been holding above this 50% really well. It digested nicely. Last week, we had that dip to the downside and then this really great recovery. Doesn't quite have the gap closed yet. I'd be a little concerned about getting that gap closed, and then it's going to put us back in that box underneath 150. So kind of need to get a breakout above that 150 for a continuation on this one. But the fact that it held the line and recovered so strongly off of this low zone, that 137 area, that's impressive turnaround. EDU, continue to keep my eye on this one. The sell-off in this is one of the examples that I use of how analysts can come out with a report. It was kind of like a hit piece, but it was a mid-afternoon analyst report that came out on this company. And I still remember the day, so it's one that really sticks with me. That was a significant beatdown that took, 2 years before it started to turn around. So it seems like they got their act together, trying to clean things up. It's got a lot of room for improvement for sure, but I continue to keep my eye on this one. It's not going to be a straight shot though. It's pretty rough. JD, another China ADR name, up 0.5%. So just barely at our benchmark. And Baba and Baidu. Now, those two, Baba and Baidu, they're not quite at the benchmark, right? We need them to get just a little farther. But yeah, it's close. It's certainly worth keeping an eye on this morning to see if they can come up and match. Baba made it now. It shifted up. So we just need Baidu. JD, PDD, BABA, Baidu, and then the EV market, XPEV, NEO, Li Auto. We can see EVs are doing pretty good. Even some of the legacy companies like Ford is up this morning. GM, not so much. Yeah, a little bit of a bull pennant on the daily. But even Tesla, Rivian, both up nice. Tesla's got a lot of resistance around that 260 though. So, even if we do get a bump to the upside, it's hard to see us getting through that 260 unless it's just low volume catalyst push. All right, crude is up this morning, but we've just been sitting inside this range. So it's IX10, but it's a really big range. Not a lot of excitement over a range this big. Even if we narrow it down into this other candle, it's a tighter range, but the range gets a little sloppy with these cuts that failed. So 75 is kind of the line in the sand here. Without getting through that 75, it's really hard to see how there's going to be an expansion to try to take back some of these older levels. It is and has been IX10 though. So, it has the compression, should have the energy. All right, so as you can see, I went out all the way, everything that we have for gold on a monthly, and this peak back here is 2150. That's the level we got to get through. But precious metals, gold is up this morning, silver, gold miners. Nat gas down again. It's not back to these lows yet, but it's getting there, right? I mean, this is it's got a lot of work to do before we turn around and get out of this. And Bitcoin down almost 2% this morning. Mara and Coin following Bitcoin this morning, just not up. Mara's down 0.5%, so that kind of reaches our benchmark. It's trying to get this gap closed, so it's not down as much as it was, but it is down. This one's worth keeping an eye on. If we can get this gap closed and get above 2680, then we could threaten last week's high and see if we can continue this. Just remember though, when we look at it on the higher time frames, so here's a daily, this thing's got a lot of work to do, right? And it's very overextended. I mean, that's got to be a picture of overextended, beautiful picture. And coin, another one that's really overextended. A lot of work to do. And we got that threat of the halfback for resistance. The banks will kick off earnings January 12th, I believe. Friday the 12th. That should be the start of the new earnings season. Yeah. So this morning, out of my little list, Tesla's doing the best, and then a couple of banks, some semiconductors, but only Tesla is up even to match the benchmark of 0.5% or better. The rest of them haven't even managed to do that yet. AMD is getting close. It's just not there yet. So I'd say the China ADRs, the EV market, those two at least give us something to focus on. Yeah, so we don't even have pot stocks this morning. So China ADRs and the EVs, which technically those EVs are right back into China ADRs, or at least the China flows anyways. So it makes sense. Keep in mind though, we saw that at the beginning, right? When I started this morning briefing, that Hong Kong was up significantly and nothing else was really up at all or down either, just kind of flat everywhere else. So it makes sense if China's up that all these China names are catching bid today. If and when these other markets start to catch a bid, I mean, we're not down, right? Not really. We're just kind of on pause. So if we thaw out and get to moving, then we could shake something loose. Market breadth tools are going to be ineffective this whole week. So the normal tools you would probably want to use just aren't going to be there, right? Tick, trend, AD, UVol, DVol, those aren't going to be any use. CTick, they're not, none of that's really going to be effective, right? Could get a little value still from the NY Fang or the Mag 7 chart, maybe the KRE, but I think for the most part, you're just going to have to focus on groups, peer groups, right? So if you're trading, say, a bank, just look at other banks, or if you're trading, you know, cloud services, trade another cloud service, keep your eye on other cloud services. Because I don't think these other tools are going to be that useful for the week. That's why a lot of people, they just take off for the whole holiday, the whole week. We have stocks and bonds just about equal this morning. So no risk parity. And the 2-year was up earlier when I was looking at it. Yeah, here's the 2-year in blue on the right side. The idea would be if we see this rise in the 2-year, that we would see the ES fall. These two really big candles right there, the two red ones, coincide with this pop to the upside. And these two blue candles here on the dollar, or the dollar index, also coincide with this push to the upside. This is that alternative market perspective, right? Watch the dollar, watch the 10-year or the 2-year, and trade in your S&P or NASDAQ. You could use an alternative VIX right now, something like SVXY, for an example. It moves in the same direction as the S&P instead of inverse. So, like with the VIX, S&P goes up, VIX goes down. VIX goes up, S&P goes down. That's kind of the norm. With SVXY, it would be SVXY goes up, S&P goes up. As for the broader market, it's still bullish. There's absolutely nothing taking that away at the moment. Looking at it on a weekly, right, there's really no argument to that. Since Tesla was really the only one up this morning out of the Magnificent Seven that hit our benchmark, I guess we could focus on that as a possible play. So we got this control candle, could just use it, line in the sand, get our 50% out of it. If we're going to remain bullish, kind of need to stay above that 254-ish. There is a potential gap close just to, kind of get a little bit of a reset. When it comes to the start of a new week, generally speaking, I would rather see a market gapped down slightly for a continued push to the upside, rather than coming in on a Monday, well, quote, Monday, the first day of the trading week, having a gapped up market. I'd rather have that gapped down market. There's a ton of instances we can point to and see where we had a gap up and it continued to the upside, but there's different gaps, right? There's exhaustion gaps, continuation gaps. Not all gaps are created equal. if we look at something like the Thinkorswim workbook, you can search for gaps. And there's this gap cloud indicator. Just keep in mind, it's Thinkorswim, so it might not highlight every single gap that you want it to highlight. And it might not mark gaps the way you want to mark them, right? Some people just go from wick to wick. Some people go from the close of that market to getting back to that same close before they consider the gap closed. So new week, open gap, new day, open gap. There's historical analysis on it, risk management, confirmation indicators, market sentiment. But you have breakaway gaps, continuation gaps, exhaustion gaps. Try to tie that in with open range studies, right? Or open range concepts. And over the weekend, I started getting into open range daily and open range monthly. It's an interesting concept. StockCharts.com website has a charting package, ACP. And inside of it, there's these different indicators. Obviously, different platforms have different tools. If you go to Open Range, they offer Open Range monthly and Open Range daily. So I kind of marked some out here on Apple. The just like our own intraday open range, you can use a 1 minute, a 5 minute, a 30 minute, 1 hour, just pivot low, pivot high. There's so many different kinds of open range on the intraday. So it would make sense that if we do go out to a daily, that there's different versions out there too. One version uses the first day of the month. And you just mark that first day's high, the first day's low. And you use that for the whole month. Another approach would be to use the first 3 days of the month. So what I have marked here is the first 3 days of the month. On Apple. You take the highest point and the lowest point in that 3-day time period and mark it out. Then you're looking for a breakout of that. So for an example right here, and then the breakout, or a possible Busby. It didn't quite get there, but these are the 1 day, marking the first day of the month, and then setting it across for the whole month. Really nice Busby there. It just adds some context, right? And it gives you something to maybe go research a little bit on your own. I'm pretty sure I'm going to be making videos on this. I had not thought about, open range on a monthly and there is one more open range. And this one would be for the start of the year. So in January, mark out the first 10 days. and again in June. So for example, here on Apple, I got the 3-day open range. Or a 1-day open range. Something to look into, right? Here's one of the pictures that I took from their platform. This is their tool where they were discussing how the tool functions and how it draws the levels. This is the one for the yearly, where you mark it in January and then you mark it in July. And it's the first 10 days. So I drew the purple line there. It counted those 10 days, and it's 10 trading days, not 10 calendar days. So you count 10 candles, get the lowest point and the highest point, draw those levels across. This is the 3-day opening range. And I brought it up because, you know, the month is almost over and we'll be getting into a new month. So we'll get the opportunity to mark out these levels. And there's a lot of markets that have reached a high and they're just digesting there at that high. Kind of like the S&P, for an example. Here, looking at SPY, we're right up into that resistance. If we hold up at this level and then we get into the new month, we're able to mark out these open ranges and perhaps focus on a whole new approach to how we want to trade not only a new month, but a new year. That's all I got for you guys this morning. EV markets, Bitcoin weakness. So if that turns around, maybe we get something out of it. China ADRs, EVs, precious metals for the upside play. Bitcoin proxies for weakness. And I'll see y'all tomorrow.